Mighty Father, we thank you for the gift of life. We thank you for each and everything you've done for us today. We do not take it for granted that we are still alive, that we still have the capability of attending these classes, these lessons, these lectures. We thank you for the knowledge, wisdom, and understanding that you've given to us, that we still do not take it for granted, Lord Father, because there are many people that have tried to learn this, but then still they can't figure it out simply because they do not have that divine wisdom. They do not have that divine conviction from you, Lord Father. But then you've given it to us, Lord Father. Thank you, O Lord, for giving us life and for protecting us and for giving us that burning will, that burning desire inside us, Lord Father. That whenever we feel burnt out or whenever we feel unmotivated, Lord Father, you always bring back the fire. You always give us reason to continue pushing. You always give us that conviction, Lord Father, about how the future could look like, about how everything could look like, if at all we just continued pushing, if at all we just continued working hard, if at all we just continued showing up every day. And I literally know that at the end of this war, at the end of this battle, Lord Father, we are going to be winners. We are going to be more and more and more and more of winners than any other time, than any other person that has ever told us maybe we couldn't make it. We are going to be extremely, extremely knowledgeable, extremely wealthy, extremely strong. We are going to grow financially, spiritually, physically, and our circles are also going to be big. So, Lord Father, today we give it to you. We decrease ourselves to exalt you. Come on and take on your space. Come on and give us that divine wisdom, that divine knowledge. Let you speak, not me, not Willie, not anyone, but then let us speak with your conviction, with your power, with your knowledge and understanding. In the mighty name of Jesus Christ we pray. Amen. Yes, so we thank God. So as usual, so today in the morning, I talked about these things. I talked about the interbank price delivery algorithm. I talked about the macro. And I said I'm not going to explain the macro and everything because simply we said that we are going to explain the input one, which is time, next week. Right now we are explaining input two, which is price. The reason being, when we start explaining time, you will feel like you've now cracked the market, which we do not want you to feel that feeling before knowing the basics, before knowing the things that you literally have to know. So this is it. Just stick around, be cool, like just be patient. At this juncture, I would just like to welcome Mr. Will to come and take us through today's evening lecture. Thank you so much.
All right, folks. I hope everyone is fine. I'll thank Alvin for that introduction and opening prayer. It's always good to lean on God because whatever we're doing become nonsense if at all it's not good. All right, so yesterday we talked about again insights of insights of what the market. Yesterday we talked about market mechanics, what makes like the engineering, what exactly makes the structures shift, what do we need to see. And we're looking at the first side. Yeah, the first side. Let me first take you back to the graphic here. This is what we've been rotating around, time and price. And then at a certain macro is a certain time window. We expect the algorithm to target either an inefficiency gap or a key high or a key low. Now we've seen highs and lows, we've seen all that, and we know why price will target such. So our focus was looking at the inefficiency gaps. What are these gaps? How do we determine them? So we've seen the fair value gap, We saw that yesterday, and we actually took it further, slightly deeper. Now, today we're going to again continue with that and dig slightly deeper. So whatever we're looking at, we're going to be using the same knowledge, the same mechanics in the upcoming struggle to find whatever we want to find it from the market. All right. So a slight review. These are the key highs and key lows that are the all the highs, all lows. This is the structure. We have the price on the y-axis and time on the x-axis, and then in the middle we have price action. So this is the engineered liquidity that you see making higher highs, lower lows, higher highs, lower lows. So yesterday we said when a new high is formulated, the previous high automatically changes to an old high. If it was a low, it will become an old low. So whenever a new level is created, the old liquidity becomes old, something like that. So such old lows or old highs will be targeted by what? By the algorithm during the price delivery. So we say, I will repeat this again, the price action that you see on the charts, the movement of up, down, back and forth, the algorithm is trying to generate liquidity that will, at a certain time, it will sweep it, something like that. But not just sweeping it, there are reasons for this. The first reason that we saw yesterday is it's offering fair value to the marketplace. If we've seen sell-side imbalances, then we expect that gap to be covered on the buy side. So that's what we've been looking on. We said all this happens, or it's executed at a certain macro at a certain time window. And we know why a macro exists now. So we looked at what an inefficiency is. We say the algorithm is designed to offer fair value where in the marketplace to both buyers and sellers. So we'll see now, we'll dig deeper to the buy side and sell side. In some cases, price rushes or quickly drifts towards a certain level. Now that drift leaves gaps, and then these gaps we name them. We give them names. For example, fair value gaps, stuff like that, or voids, etc. And we anticipate price to come back at a certain time, maybe tomorrow, maybe next week, to revisit such levels. So now that reversal is what we call, if you remember this, we call it repricing. So this is the term that we'll be using, either a reversal, but it's repricing to certain levels. So that action is what we call repricing. So in order for the algorithm to maintain its fair value parameters, it will reprice back to such inefficiency gaps to rebalance, to offer. Now that rebalance is what we call offering fair value. Things have to balance. So now we looked at a displacement. So a displacement, an FV indicates that the algorithm which we refer to as IPDA, we know why IPDA, to remind you, it refers to the interbank price what? Price delivery algorithm. I'm so sorry about this. Yeah. Alvin here his trade has just hit TP and he's laughing.
TP is hit.
Sorry about that. Anyway, we continue. So an FVG indicates that the algorithm in play is in a hurry to move price in a certain direction, can be either an upward direction or a downward direction over the other. So this is an algorithmic footprint in price action. So this is key. So larger institutions like banks, etc., with deep pockets enter the marketplace at such levels. This should be noted at key support and resistance level. So I'm going to give you an example here, or something like an analogy. You take this as a displacement is whereby you see those big candles, most so during news. People who have been trading news, you normally see those big candles, but it doesn't happen during news hours only. It happens almost everywhere in the marketplace every day at certain key time zones or macros. Now, whenever we see these displacements, we expect fair value gaps to be created. Now, how does the displacement happen? We are saying larger institutions with deep pockets. Deep pockets, that refers to banks that have a lot of money, a lot of liquidity. Now, take an example of a foot of an elephant, and then that elephant is stepping in maybe a pool, a swimming pool for babies, maybe a basin. Like someone with a big foot is stepping into a basin full of water. What is going to happen to the water? It's going to be displaced higher. So it's like you're stepping into a plate of water. What is going to happen to the matter that is in that plate? It's going to be displaced with force. Now that's what we mean with a lot of force. That's when you see candles running. And what did we say? We don't chase such candles. We wait. We target these. We mark out these gaps that have been left, and we wait for it to do what? To drop back. And that's when we enter. And we know why. It has to reprice back in order to offer fair value. Okay, so now yesterday we also saw the fair value gap on the upward movement in a bullish market. So we say these gaps are created by three candles. The first one, the second one, and the third one. The candle in the middle is what you need to label, but you need to take note of the wicks of the first candle and the last candle in the three candle pattern. Those are the wicks that you label out. Now the gap in between that was left, as long as the wicks of those candles didn't overlap. Overlapping is whereby something bypasses the other. If the wick of this black candle here, this black candle, overlapped with the wick of the third candle, the green one on top, you can see that. That means there is no gap, there is no inefficiency left, there is no imbalance left. So we don't expect price to come back to such levels because fair value has been already offered. But when you see such gaps, these are imbalances in market, during price derivative. This indicates that the algorithm was in a rush to maybe to reach a certain key level. So if for you come and label that what? That gap. So if the market has been bullish, meaning if at all the market has been going up, moving upwards, the way you see this gap is given a name. And what is the name? It's called a buy side imbalance. An imbalance that has been left during buying, during the when the market was attacking the buy side liquidity. So it's an imbalance for the buy side. Now to the sell side, what happens? It's an inefficiency that was left. It's like a debt that wasn't paid to the seller. So we expect market to sell back to such levels and then it will continue. So that's why we call it buy side imbalance, sell side what? Inefficiency. So for a BC to be created, this is what it indicates here. only buy side was offered. So if only the buyers were catered for, that leaves a gap or an inefficiency to the sellers, to the selling side. So we expect it doesn't need to happen there and then. It doesn't need to happen tomorrow. It can happen next week, whereby they come back to such a level to offer what? Fair value. All right, let's continue. So the body where no weeks overlap is all buy side delivery and inefficiency to the sell side phase. So we saw that yesterday. Now, for when the market is bearish, that means the market is moving downwards. We have down close candles. Down close candles, those are candles now that are dipping. The black ones or the red ones, if at all you use charts with red candles, that are going down. So whenever a market is in a rush to attack some sell side liquidity, it will leave such gaps. Now here the algorithm repriced to the sell side too quickly, leaving a sell side imbalance or a sell side gap. Let me repeat that for you. In this example, the price action rushed quickly towards the sell side, leaving such a gap. And how do we call this gap? A sell side imbalance. Now it's an inefficient to the buy side or to the buyers, and it needs to be covered. Now the return to such a gap, we call it, that's when we say the algorithm has now offered fair value. It has now evenly distributed the marketplace. All right, let me continue. So people, we saw that yesterday. That's why I'm not wasting a lot of time here. Just that we're doing it all in trading view. I hadn't prepared the slides. All right, now when does this when does it has to do, when do we revisit such, how do we revisit such sell side imbalances? We call it redelivering of price. So that's that's whereby you see a candle coming back to such, or price coming back, repricing back to such levels. Here, this is a bearish market. The market, that meaning the market was dropping downwards, leaving a gap. Now, what do you expect as a trader? You expect this gap to be attacked at a certain time. Now, this is what happened. This is the redelivery of price in such a gap. Here, buy side movement has been redelivered back through the sell side imbalance. The inefficient sell side imbalance has now been matched with the buy side price delivery, offering us a balanced price range. Balanced price range. Now we'll look at these balanced price ranges sometime in the future after looking at market structure sheets. So now there is a balance, there is a fair offering of the price on either sides, on both sides, on the sell side and on the buy side. Now, this is when we see now price dropping a little bit. When price passes through this range for a third time and leaves, this whole range has been rebalanced. Any upward movement back through this range should be met with high resistance. We're going to look at resistance and support. So when you see this, when you see candles purging this gap and then dropping back and then cutting it again for the third time, we don't expect price, we expect this gap now to act as a high resistance level, and then to offer, if something is resisting, it acts as a wall. So it will be price will bounce off here and then continue dipping down. That's what we mean. But we're going to see other scenarios whereby until, yeah. So we're still discussing the sell side imbalance, buy side imbalance, sell side inefficiency. So a BC and a CB, those are both fair value gaps. All right, we saw an example of this imbalance being rebalanced, whereby price retraces or reprices back to that gap and then leaves it. All right, so we're looking at support and resistance. So in a three-level structure. So what is support, what is resistance, and how do we apply the same logic to fair value gaps or to inefficiencies? Now, we subdivide the gap into two sections, into two quadrants. You get your box or your lines, you draw in the middle, you cut it in the middle, and then so that you have the upper quadrant and then the lower quadrant. The upper one is what we call the premium. The lower one is what we call the discount. Now these two quadrants that you've subdivided, each one is taking 50% and we have 50% below. Now how do they become support or resistance, and which one is resistance, which one is considered resistance, and which one should we consider support? Support is like a push you give someone to continue. Resistance is like you resist something to go through and it bounces back. You get? So it's the same logic that we're going to be using here. We've said you get your fair value gap, you divide it into two. You bisect it into two pieces, equivalent pieces. 50 up, 50 down. Now, the lower part is what we call a discount level. The upper part, we call it a premium level. Now, the line in the middle, where this gap has been bisected into two, it's the 50%. You get? It's the 50%, and that's the midpoint of these two quadrants. Now, there is a special name we give this midpoint. We call it a consequent encroachment or an equilibrium level. But you can just call it a midpoint. So don't get lost with whenever you see such terms, consequent encroachment, equilibrium. But equilibrium means somewhere in the middle. So now, since we know how a fair value gap formulates, but we didn't know these levels do what happen. Now, the upper quadrant is what we call the premium, the lower quadrant is what we call the discount. Now, what happens? In the upper quadrant of the fair value gap, this is what we should expect. The premium or the upper quadrant of the fair value gap should offer support in a bullish market. If the market is going upwards, and then we see something like this, we see a purge, we see market now, the market has been going down, but then abyss has been created, and then we see candles now purging it, upward candles crossing that fair value gap with momentum. And what do we expect to see? We expect to see price coming back, retracing back, where? In the first half, the top part. So we expect it to reach that, to tap that gap and then continue up. In other words, we are saying we need to see the upper quadrant or the premium level of the inefficiency act as support for price to continue upwards. If price has closed above this level, this level becomes a stronger support if the fair value gap has been balanced. In other words, rebalanced. You get? Now, the lower quadrant. For the lower quadrant, which is now the discount level, this is what we should expect. for the discount in a bearish market, we should expect it to act as a resistance level for market. Instead of market going upward, we expect price to come back here and then continue dropping down. We're going to see this with live examples. So if price has closed below this level, we expect it to become a stronger resistant level to push price lower. We'll revisit these levels. So now there is what we call a volume imbalance. A volume imbalance. We saw this yesterday slightly. So a volume imbalance, this occurs when there is an area of price that has been left without candles, without bodies touching each other or coming into close proximity. So there is an upward and downward movement in the overlapping of the wicks. However, since the bulk or the volume is in the body, and then the body didn't come into close proximity, we expect price, we call this gap that has been left untouched by bodies, we label it a volume imbalance. And how does it come into play? We seek wicks of the wicks of the candles, the two candles, almost overlapping. They can overlap. We can see only one wick from one candle, and then the other candle doesn't have a wick. But that gap in between, we call it a volume imbalance. So you can notice how bodies are really far away from each other, leaving wicks to overlap each other. So we call this a volume imbalance. So I put another example B, whereby you see one candle with a wicking in that gap, and then the second candle does not, it's just a flat body, no wick. So also that is referred to as a volume imbalance. So let's look at a gap or a void. Yes.
I have a question.
Yes. You can ask.
So that volume imbalance, price can come absolutely then access support or in a bullish scenario.
Okay. It can do what?
Like act as support in a bullish scenario when price hits that area.
Yeah. So we expect this is a fair value gap, but it's a void. There is no price action. Like if it is a volume imbalance, for example. So we expect again price to come back here and tap it and then continue. You get it. It's the same analogy.
Understand.
Yeah. So you mark such levels and then you expect price to reverse back in time, to reprice back to such levels and then bounce and then continue upwards. You get?
Yes, sir.
So that's why we label them. So now we've seen three types of fair value gaps. So we've seen a fair value gap itself, which is the most common one, this one, and we've seen how we bisect it into two pieces, into a premium and a discount. And we've said if you expect price to continue upwards, it should stop honoring the premium level. Yes. Yes, Bertram.
I'm just saying close above the premium.
Yeah, exactly. Now, if you expect price to continue lower, that means to continue dropping. The moment it comes back, you want to see it stop in the discount level in the first half, and then continue dropping down. So you've seen people analyzing fair value gaps, and then they put their entry level at the mean threshold. Mean threshold is this midpoint, and then they wait for price to come back here and then tap it and then continue dropping. And in most cases, the market doesn't come back to the mean threshold. It just taps a little bit here, lower here in the discount level, and then it continues dropping down. You get? So when you have such knowledge, you'll be able to maximize on that to capitalize on such one. You refine your entries. Okay. Talima, you've raised your hand?
Yes, my question is,
Yes.
for you to know your own price comes back to the fair value gap, but it doesn't complete
The whole gap, yeah.
That's,
Mm.
just the weak gaps in the system. Do we count it that the fair value gap has been mitigated, or we still consider the value fair gap of future price action?
It's mitigated. It's like fair value has been provided. It has been offered by the algorithm. The moment it taps, so we'll see underlying other factors that make such levels being what? We'll see why price does not need to come back to fully cover the entire gap. We'll see why by looking at the price action prior to the formation of the fair value gap. We'll see why in the charts. But right now we're just focusing on this, you get. So also I'll show you some entries, like some previous entries that I've screenshot, and you see where I put my entry, and then you see price fighting, coming back and forth and retracing in the same, if it is premium, maybe going upward, coming back to the same gap, like multiple times, and it never crosses down, never goes beyond the 50%, and you're sure, and then it kicks off at the right time, and then it shoots up. Okay, let me go to YouTube before I continue. Let me go to YouTube, and we see this. Yeah, there is a video.
Are you recording this session?
Yeah.
Recording.
So let me see. It's the trading. Let's see this. Let me switch. Let me first switch to YouTube and we see this. Let me go to playlist. Let me go to executions. The executions of inspirations. Sorry.
It's a reminder that action.
Let me just drop down in the history. Let's see. There's a buy tool.
Is where you determine where you are.
But here's what he said to me. In climbing this ladder economically, all you have to do is work hard.
So let's just look at this action. Is it clear? Let me increase the watch.
Now, what a contrast for me. Farm boy from Idaho, raised in Sterling, parents of modest means, broke when I was 25. How come I would get a telephone call that someone offered?
So there is.
What's happened to them, the mistakes they made, how they corrected them, how they changed their health.
There's some good clean price action too.
Cassette tape. All of the time I was 18. That's been so beneficial. Major things my teacher taught me was to keep a journal.
So for example, let me first pause here. You can see this gap, and you see how the price kissed in this gap in the upper part, and then just continued upwards. There's some clean one. I think I posted the screenshot on my X.
We need to take a look at why they don't have.
Because this is what we're going to be doing.
And then if you can add some drama, check it. Things you want to have, the person you want to become.
The same. Now you see,
the home you want, the future.
and this is not clear. Let me go to Sorry about that. Let me just go to my screenshots and display one. Or let me go to my X because it's there. My Twitter account x.com. So I want you to see this like clear, so that because these are the things we're going to be applying in the near future. Probably next week we'll start application. We go to the screenshot. Was it January? Feb? Like almost all the entries should happen there. Is your X now for example is this chart? How do I display this chart? Let me see. Let me drop it here. Okay, so I've got for you an example. But if you're critical, you've been noticing our screenshots, you will see this. So there is that. I hope we can see this. Look at that cell. Yeah, just look at that cell where here. I hope you can all see this. Look at that fair value gap. Are you seeing it? Now, I marked it with two. You can see the colors of the boxes. The cyan, that is like bluish, it's cyan. And then the orange, just that it is too light. So the cyan is marking the upper quadrant for the premium. So I don't expect to see price going that side. If it goes up there, that means it's providing you with, like, I'm buying I'm selling at a really lower cost, anticipating to sell it off to sell off whatever I bought in the marketplace at a higher one. That means I'm getting things that really for cheap, at a really cheaper price. But you see me marking two quadrants, the upper quadrant and then the lower quadrant. The lower one is the discount part, this discount level, and you will see how price came back to that gap twice. You could see this first candle and then the second one that dropped, the black one. So that will be my entry. For me, I just put my entry there at the opening of that fair value gap, like 2 ticks or 1 tick. So I don't mind whether price goes back in almost kissing the mean threshold or the midpoint. I don't care. Now, in most cases, you will see me adding more entries the moment it comes back to the mean threshold, as long as I'm right on the bias and I've seen this shift. So such levels, so people will wait for price to come back at the mean threshold or in the mid of the fair value gap. You'll be wasting your time in most cases until price distributes downwards, taking out the previous cycle, the previous lower lows, whatever it is, and then it will retrace back. You get. So I hope that example is fine, even though I don't pull up a lot of examples. Yes, the way guy is saying that's fine. Thank you, even Bertrand. Yes, so yeah, So there is also this one. There's a lot. I have a lot of screenshots highlighting this. Now there is this example. Let me drop it here for you to see a change. Let me switch. So there is that. That was a buy. But this fair value gap was on a 5-minute chart, but I just switched it to 1 minute. And you can see the upper quadrant labeled and the lower quadrant. So I entered. I hope you can see that green arrow. Sorry, blue arrow. That means I entered buys. Blue is for buying. The red is for selling. So I entered 3 contracts on the Nasdaq here. Anyway, 3 contracts. Just take it as 3 lot sizes for the sake of lots. But we'll see this maybe for people who wish to start trading futures. We'll see why they are called contracts. Anyway, you can see I marked the upper quadrant and then the lower quadrant of a fair value gap, but this fair value gap was on the 5-minute chart. So it was a 5-minute FVG that I had labeled. Now the moment price retraced back, actually the thing is here. The moment price retraced back, this is what I did. I just entered there. Let me show you the 5-minute chart before that happened. But now you're seeing that price indeed came back and dropped past the mean threshold of that 5-minute fair value gap. And that trade, it again dropped lower to the discount level you get. And then it retraced and then it continued upward. So such scenarios would happen whereby price can go and kiss the mean threshold or the midpoint of that fair value gap and also drop the discount level. The discount level here is this yellow one, the yellow color. The cyan color, that bluish color is the premium. So the moment I see price tapping, like I see a candle tapping there, I just press my entry, buys, full stop. So the moment price continuously drops again, dips, I can decide to add another contract, to add another lot, to add another entry for buys. And you see how again, eventually price kicked off. But that was so this is let me show you the 5-minute chart before we proceed with our explanation of that version. So this is the 5-minute before it all happened. Now you see my entry. You see where I entered. I'm trying to zoom in for you. So you can see that the moment that black candle popped or wicked into the upper quadrant, the premium quadrant, I just pressed my entry and look where my stop loss is. It's below the fair value gap. Sorry, below the candle that formulated the fair value gap, and I don't change it. So I don't mind whether price comes and then reaches the lower quadrant, the discount level. It's okay. I don't alter my stop loss. The moment they violate it, then I just know price is now going to change route. So you get. So that was the before. So that was the before. But again, price didn't. In this example, price didn't stop in the premium level. It continued downwards, dropping into the discount. You get. All right. So I think that's fine. So let's switch back. Ivan, you've raised a hand. Yes, you can ask.
Kindly go back to the chart before.
the chart, the 1 minute. This is the 5 minute of version of the other chart. I switch? Okay. I think it's the one. Yes, that one.
So can you please help me see the fair value gap here? Because I'm only seeing the colors. I don't know where.
Now this is a 1 minute chart. It's 1 minute. You get. But the previous one, I made analysis on the 5 minute and I labeled that gap where you see the colors, the two colors. The blue one, the bluish, and then the yellowish color. That is the gap of this, from this what? From the 5 minute, this is the 5 minute, before it all happened. You can see that gap there. But this is the 5 minute chart. Actually, you can also clarify here, up here. This was a screenshot from what? Papers. Sorry, from TradingView. It indicates the time. You can see 5 up here.
Yeah.
So that means 5 minutes. Now you can see that gap clear. That fair value gap. You get it?
Yeah, I get it.
Yeah, so then I divided that gap into two. Here it's one candle. This candle is 5 minutes because we are under a time frame of 5 minutes. But when you drop down in a 5 minute candle, when you drop down to a lower time frame from a time frame of 5 minutes to 1 minute, that means each candle is 1 minute. You get? That means in this movement we expect to see 5 candles. So let's switch back to the other what? To the other 1 minute what? So now you see, that's why you're seeing a lot of bullish candles, but those should be like 5 candles. One, let me count them. They should be 5. Yeah. So 1, 2, 3, 4, 5 up there. So those are 5 minutes. On the 5 minute chart, it's like one candle, up close candle. And then your task is to divide that gap, the fair value. Now you know how a fair value gap forms. But then you need to, we are taking it further, next step. We divide it into 2 pieces. And then we're saying, if we're to buy, if we're anticipating for the market to continue upwards, however much it is, the market is dropping back, the way you see this chart, it dropped back to this gap. But for you, you're sure it has to buy. So if you're sure that it has to buy, you press your entries in the upper quadrant, in the premium. That's where you put your entries. Yes.
I'm not seeing the screen. I don't know whether the others are seeing.
Yes. Yes, Regan.
I wasn't seeing the screen, but I'm now seeing it.
Yeah. You gain. So for me, that's where I put my entries. Let me see if I can show you another chart so so that we can continue. So people who wait for price to tap into the middle of the gap, there is also this. Let me just drop this here. So I told you people to, was it last week? Was it Sunday, Saturday? I told you to always take screenshots. Okay, take screenshots. Go find somewhere they print from, like a printer house shop, and do what? And print out your screenshots. People who are lazy on taking what? Journaling. If you're lazy, just take screenshots with notes maybe, and you keep them. You can revisit them in the near future, and you see how you've been. I think this is it. Well, this was the first one. Yeah. Sorry, I already showed you that screenshot. Yeah, it's here. It's a little bit chaotic, but you can see. So where I see those blue entry points, that's where I was punching in now, like adding in more entries. Now you can see that fair value gap. And let me try to zoom in. You can see that fair value gap. The moment they formulate that, I divide it into two. So my entries in the upper quadrant in the premium for buys. I don't expect price to come back down here, but check, price dropped but only wicks did what? Drop into the lower quadrant. You can see that gray can that dropped. Let me zoom in. You can see that fair value gap, and then price dropping down. So we don't expect that, but it happens. So when it happens, you can just add in. It's like someone is offering you at a discount. You're buying at a very, very cheaper price. You get you're buying a commodity at a very cheap what or a cheaper price. That's whereby you see candles dropping or wicks dropping into the mean threshold, even past the mean threshold through to the discount level. Yeah, and then it will continue upwards like that. You take your TP. And again, you can see the same here. Like also there's another gap. I hope you can see this gap that I labeled, where you see the three blue arrows pointing up. Those are entries for buys. Now again, that gap I divided it into two. Now you see where the candles dipped in the upper quadrant and then they shot up. They continued upwards. So that's what we're talking about today. So we expect such levels, a premium level, to act as support for price to be pushed up. The moment price drops into that gap, into the 50%, the upper quadrant, we expect it to do what? To act as support, to support price upwards, to give it momentum to push upwards if we are to buy. But if we are to sell, we expect the lower quadrant to act as resistance. If we are maybe we are in a bearish market, yeah, something like that. So any questions, people? Yes, Adrian is asking. You've raised up your
My question is,
yes.
my question is, when do you know your, because if you look at 1510, that big massive,
yeah.
the time 1510, there is that fair value gap that was tapped and tapped. Probably that would
you would sell.
tell somebody sell.
Which
But
fair
if you
value
look
gap
at
are you talking about? This one on the sell
yes,
side, the BC, this one on the black card.
That
Now why do you think I didn't sell there?
that I don't know, because it's like a fake out something like that.
Yeah. So now this is whereby this fair value gap is violated. You expected it to do what? To act as what? Resistance in its lower what? Quadrant. And indeed it tried to act as resistance. But because of the underlying rules that we haven't looked at of a market structure shift, the moment they pad that volume, that fair value gap, with another fair value gap, you're seeing on the right hand side this bullish candle that pads it with a fair value gap. So we have two fair value gaps on the left and on the right. You just know that we've changed structure. We are now going upwards. You get, now you're waiting. So in most cases, price after purging this with momentum, it will shoot upwards. Now you can see it shoot up to into this blue gap, blue shade that I shaded. You don't chase that, you wait. Where do you wait? Here in this gap. You wait for it to drop. It will drop. You just be patient, it will drop. The moment it drops there, you just buy. But where exactly? In the upper quadrant, that's where you put your entries. We will see this in the, don't worry about this, we'll see all this. You get, and we'll go into the charts and look for these things and we trade together. You get, so don't worry about that. Yes, anyone with a question? Anyone else with a question? Do you want to see any other example, people? Do you want to see any other examples, things like that? Or I continue? Yeah, I'm seeing thumbs up. I don't know whether they mean we continue or I show you my examples, then we call it off. Yes, Murilo is saying continue. Okay. All right. Okay. Let me switch back to what? Is trying to switch back to our what? Yeah, the mentorship. Can we see that? People, can we see that? Yeah, it has come up. Okay, so we've seen this and we've seen some examples. People, those were real trades, entries, but in January, so in Feb, something like that. So that is premium and discount. We'll again revisit this analogy. So we've seen volume imbalances and voids. Now a void, it's also a gap. But how does it happen? The gap that occurs when there is an area of price, delivery, including, sorry, when I made a mistake here. This is a gap that occurs or that is created with two bodies, two candles, but with no wicks at all in between. You get, like nothing happened. So it's like a skip of time, and then it's like you agree to meet at a certain time in the market to transact, and then people don't show up. You get, but time continues moving. You get, time continues moving, and maybe we are supposed to show up at 10 in the morning, but no one shows up, and then time goes on and on until 4 in the afternoon, in the evening, and then that's when people show up. So this 10 a.m. meeting, we skip it. That is the gap, that is the void. It's like no price action happening in such gaps. So these gaps are really powerful. They will attract price the algorithm will be pushed to reprice to such gaps more than the fair value gaps. So if you see a fair value gap in line with a void, just take the void. The void is more powerful, it's more magnetic, if I'm to put it like that. So when do such gaps happen? Whenever a new day is maybe a new week, you see the market stops on Friday. So we expect the charts to do what? And unlike for people who are trading crypto continues. But for other pairs like Forex, like futures, indices, etc., they stop on Friday, in the late Friday, closure of the day. Now, when Saturday kicks in, that means the charts have stopped. But that doesn't stop time, you get. So time continues to move. That's when we come from Friday, Saturday, Sunday. Now, when Monday opens up, 2 days were skipped. Nothing, no transaction happened, no trading happened. No exchange of goods and services happened during Saturday and Friday. So, and then the transaction again happens back or returns on Monday opening. So that gap, that skip of time, that is what we call a gap. That's whereby you will see such gaps. You get. Also, these gaps happen when on public holidays whereby banks close up. They close up and then maybe they come back in. They come back tomorrow. Normally, banks during some public holidays they open in the morning like at 8:30. They close in the afternoon like at around 2. Now, for example, last was it February when Trump was being sworn into presidents. So the bank stopped in the afternoon, but the stop of the markets left a gap. When the markets returned back the following day, we saw such gaps. You get. All right. So you can notice how bodies are really far away from each other and no wicks are present in this area. This space is termed as void, like no transaction whatsoever, meaning no price action occurred at all. So this is really powerful. We'll see. So that is the gap for you. So then we'll look at swing highs and swing lows tomorrow. I will start from here. Let me first go back here. So I hope people, no questions, that was clear. I'll repeat this for people who were interrupted by power, our friends who have not managed to do what? To continue with the what? With the lecture. Allow me to, unless you have a question, people, anyone with a question before I close it up. Yes, Molindo. Adrian.
About that void thing here,
Yes, the void.
You say that if you tap the void and the fair value gap, which one is stronger?
The void is stronger because no price action happened, and you remember our main important the main important function of the algorithm. There are two main important functions. One, it has to offer fair value to who? To the imbalances or to the gaps or to the voids that were left untapped, uncatered for. That is one. The other alternative, the other importance of the algorithm is to generate liquidity in the marketplace. Those highs and those highs and those highs and those. So those are the main two tasks of the algorithm. Yeah. So I think you can see this chart. I'm going to close it here with this example. Let's look for these guys. Let's see where Monday opened. Let me switch to maybe to the daily. Let me switch to this 41 to a daily candle. Now these are daily. This is a daily chart. This is a daily chart. That means each candle you see, it's one day. It's 24 hours of run time you get. Now look. This is Wednesday. This is Tuesday. Look at these gaps. Look at that gap. So that is a volume imbalance. We can see a week from one of the candle and then another week from the other candle. So this becomes a volume imbalance. So now this level, we expect price to come back to it with momentum. So what you do, you label that gap and you extend the what? Now let's see, when did this happen? This happened between Tuesday 16th. Tuesday 16th, that's where I plotted that what? Between Tuesday 16th to Wednesday 17th. So that's when that gap was created. So those are the two lines between Tuesday 16th and Wednesday 17th of July last year. Let's see when they revisited it for the first time. Thursday, tapped it, dropped down. Monday, tapped it. Tuesday, Tuesday, last Tuesday of 2024, tapped it. You get like that. So they came back and revisited that price action, that gap. Let me go here where we are. Let me go to maybe 15 minutes or to 4 hours. Let me just go to 1 hour, it will make more sense. 1 hour, the 1 hour chart. So now we can see these gaps that were skipped. There is this. So there is this. Now let me make this orange. Now you see that orange gap. Look at this candle. The green one, the first one here. This one. It has no wick below it. It's a flat body. Look at the second one. There is a wick. So that is not a void, it's a volume imbalance. There is one wick that pops inside. Now look at this other gap. This black candle here and then this candle. The green one, look at the wicks. The wicks are the ones overlapping. You can see the wick of this. Let me bring this white in the middle for you. You can see the wick of this black candle and then the wick of that candle. So your task is to label that. So we call that a volume what? Imbalance. Let me change it to red or to cyan here. Now you expect price to do what? To come back in this gap. And indeed price came back for the third time and violated it. You get it. So search gaps. Again here. So let me see if I can see avoid. This is another volume imbalance here. There are very many. That's how you find them. That one here. So whenever you see such gaps, you mark them, you wait for price to do its thing. It will eventually come back there. There are very many, we cannot. Yeah. So your task tomorrow, as we wind up this, is to go back in the charts, look for these gaps, label it, try to mark them, name them, stuff like that, and see how price action worked upon these gaps, how it came back and reversed, something like that. And you label those things, take notes, and then screenshot and you share with me or I'll read. So with that, allow me to stop the lecture here.
Someone volunteer to end the prayer.
Also, maybe we'll ask someone should volunteer for the closing prayer. Today has not been easy. Yes, Frederick, either Regan, Frederick, Adrian, Tommy, Saifa. Saifa has prayed for us several times. Yes, anyone to volunteer? Yes, Adrian, you're taking on. Yeah, thank you very much.
Let's humble ourselves for prayer. Lord Jesus Christ, we come before you. First of all, to be grateful for today. Very grateful for everything that we have gotten today, the knowledge, life, opportunities given to us today. We are very grateful. I would pray that you grant us the opportunity to see tomorrow so that we can put what we have learned into action. Yeah, and also we pray for the ability to grasp whatever knowledge our brother Alvin and others that they are giving, that protect us this night so that we can see tomorrow. In Jesus' name we have prayed.
Amen. Thank you very much, Adrian. Yes, Frederick, you're saying something?
Yeah, I'm just requesting that tomorrow, if you can help us, or you can help me pass through how to use demand and supply.
Demand and supply. Yeah, I'll repeat it for you guys. Okay. But I'll repeat it faster. Yeah.
I know. I usually use it, but I'm not sure. Okay, I'm not.
All right, Frederick.
Yes.
For demand and supply.
Yeah.
Tomorrow in the morning lecture, I'm going to talk about demand and supply.
Okay.
Then we shall also talk about it in the evening. Basically, we are going to be using order blocks. We all know that demand and supply levels are literally order blocks, right?
Yeah.
Yes, so tomorrow.
Thank you.
You're welcome.
All right, thank you very much for sticking around and taking the notes. So tomorrow we are continuing. We'll see how order blocks are formulated, and then the following day, that will be Thursday, we'll be discussing structure shifts. Now the real deal now. Okay. Yeah. So thank you very much. Have a good night.